Ladies and gentlemen, friends, fellow investors, what I am about to tell you may seem extreme, but it is grounded in history, in data, in cycles that repeat. Imagine gold trading at a 34,000 per ounce. Imagine silver at $2,000 per ounce. These are not fantasy numbers. They are signals. Today, they are warnings. And today, I speak to you not merely as a commentator, as someone who sees what is coming and wants you to act before the storm hits. Let me be clear. This is not a call to panic. It is a call to reason, preparation, and courage. The story of markets and economies is not a series of random events. It is a rhythm, a recurring pattern that stretches far beyond the short-term ups and downs people obsess over. When you zoom out, you can see the great arcs that have repeated for centuries: the rise and fall of empires, the expansion and contraction of credit, the creation and destruction of money. These big cycles are far more powerful than the daily noise of a stock price or a quarterly earnings report. They move slowly, almost invisibly, until the moment when their force becomes undeniable. At the heart of these long waves is debt. Credit is an extraordinary invention. It allows growth beyond what cash on hand could ever support. But every credit expansion plants the seed of its own reversal. When borrowing becomes easier than saving, when promises to pay multiply faster than the ability to honor them, the system eventually reaches a point where it cannot carry the weight of those promises. Central banks respond by creating more money, lowering interest rates, and buying assets to keep the machine moving. For a time, that works, but each intervention requires more than the last, and each one pushes the system closer to the limits of credibility. History is filled with examples. The Dutch, the British, the Americans of the post-war era, each dominant power rode a long wave of rising productivity, strong finances, and reserve currency status. Each also reached a phase when spending outpaced income, when debts mounted, and when the political cohesion necessary to fix the imbalance eroded. In those moments, the currency itself comes under pressure. People lose faith in paper promises. They look for assets that cannot be printed. That is when gold, silver, and other real stores of value rise, not because they have changed, but because everything else has. We are living through a late stage of such a cycle. Global debt levels are higher relative to income than at any time in modern history. Governments rely on deficits to sustain growth. Central banks have pushed interest rates to historic lows, and when that was not enough, created trillions of new dollars, euros, and yen. These policies have kept markets afloat, but they have also distorted the relationship between money and real value. Investors chase yield wherever it can be found, often ignoring risk because the cost of borrowing feels negligible. That is precisely the kind of environment that precedes a reset. This reset does not arrive on a schedule. It builds as confidence erodes. At first, people assume the authorities will find a new tool or policy to extend the cycle. Gradually, evidence accumulates that the old tools no longer work. Inflation may appear in consumer prices or in asset bubbles. Political divisions widen as different groups demand conflicting solutions. International tensions increase as rival powers compete for resources and influence. Each development adds weight to a system already near its limit. When the breaking point comes, it often surprises those who have grown accustomed to the calm. A currency crisis, a sudden spike in interest rates, or a loss of faith in government bonds can trigger the shift. What looked like stable wealth turns out to be dependent on the credibility of promises that can no longer be kept. In that moment, the question is not how to profit, but how to preserve purchasing power. Understanding these dynamics is not about predicting a specific date or price. It is about recognizing where we are in the arc of history and preparing accordingly. Diversification, prudent debt levels, and a focus on real assets are not acts of fear. They are acts of realism. The past shows that those who wait for obvious signs of trouble are always late. Those who respect the cycle and position themselves early are the ones who maintain their freedom to act when others cannot. The lesson is simple, but not easy. The forces driving the big cycle are larger than any single leader, policy, or market move. They are the accumulated outcome of human behavior repeated over generations. To ignore them is to mistake a rising tide for permanent prosperity. To understand them is to see that every period of excess contains the blueprint of its correction. We are approaching such a correction now. The prudent course is to observe with clear eyes, reduce dependence on promises that can be broken, and hold what endures when the cycle turns. When you think about protecting wealth, the first instinct is often to diversify across stocks, bonds, real estate, and maybe a few alternative investments. That can help smooth out the small fluctuations of ordinary market cycles, but it does little when the entire financial system itself comes under pressure. Most assets, no matter how different they look on the surface, are ultimately tied to the same foundation: the health of the currency, the credibility of governments, and the willingness of borrowers to pay what they owe. When those underlying pillars weaken, correlations that seemed low suddenly spike. The insurance you thought you had turns out to be just another version of the same bet. Is where gold and silver play a unique role. Unlike shares of a company or a bond issued by a government, a bar of gold or silver is not anyone's promise to pay. It has no counterparty risk. It cannot be printed or defaulted on. It does not depend on an income statement or a central bank policy. Its value arises from scarcity and the collective recognition over thousands of years that it is a reliable store of purchasing power. That is why in every major monetary breakdown, from ancient empires to modern hyperinflations, people have turned to these metals. They are the assets of last resort when trust evaporates. The power of this form of insurance becomes clear when you study periods of crisis. During wars, revolutions, and debt collapses, paper assets often move together in a downward spiral. Equity markets sold off, government bonds lost credibility, real estate transactions froze, and even cash became suspect when inflation eroded its buying power. Yet gold and silver frequently held steady or even rose, not because they suddenly became more productive, because everything else became less certain. When fear takes hold and the question becomes not how to earn more, but how to avoid losing everything, the market naturally seeks something no one can dilute or devalue. This independence also shows up in less dramatic times. Gold and silver are not perfectly correlated to inflation or interest rates. They can move for reasons entirely their own, reflecting shifts in monetary policy expectations, geopolitical risk, or simply the recognition that portfolio insurance is underpriced. An investor who treats them as a speculative play on inflation misses the deeper point. Their primary function is to stand outside the traditional financial architecture. They are there to balance what you cannot predict. Owning these metals does not mean abandoning other investments or predicting imminent disaster. It means acknowledging that the world is uncertain and that history is full of surprises. No one forecasts the exact timing of the global financial crisis, the pandemic shock, or the sudden currency collapses that have punctuated the last century. But those who held a portion of their wealth in assets beyond the reach of printing presses found themselves less vulnerable. They retained the ability to act when others were trapped. It is important, too, to think about them as a form of liquidity when conventional liquidity disappears. During severe market stress, it can become difficult to sell what you own at anything close to a fair price. Markets seize up, buyers vanish, and leverage forces sales at any cost. Gold and silver are recognized everywhere across borders and cultures and have a depth of market that few other assets can match in times of panic. They can be exchanged without depending on a functioning banking system or a particular government's permission. Some argue that these metals do not produce income and therefore cannot compete with productive assets over the long run. That view misses the essence of insurance. You do not buy fire coverage for the annual return. You buy it because one catastrophe can erase years of gains. A modest allocation to gold or silver serves the same purpose. It is the ballast that keeps a portfolio upright when a storm arrives. Over a full cycle, the cost of carrying that insurance is small compared to the devastation it helps you avoid. The challenge is psychological as much as financial. In long periods of calm, it is easy to believe that paper assets will always be convertible to the goods and services you need. It is tempting to treat gold and silver as outdated relics. But the very moments when they seem least necessary are when they are most valuable. When confidence in money and policy is high, the price of insurance is low. Waiting until confidence breaks means paying far more if you can find supply at all. Prudent investors do not try to time the exact moment when the world will demand hard assets. They accept that uncertainty is constant and that some risks cannot be diversified away by ordinary means. By setting aside a portion of wealth in gold and silver, they build resilience. They give themselves an asset that behaves differently, that answers to no central authority, and that has proved its worth through every conceivable crisis. That is the essence of non-correlated insurance. It is the piece of your portfolio designed not to win the race, but to make sure you finish it. In periods of rapid change, the greatest danger is not a sudden market swing or a headline shock. The greatest danger is being unprepared, locked into a single outcome, hoping the world will conform to a forecast. Life and markets do not respect forecasts. They move in unexpected ways, shaped by forces too complex for anyone to map in advance. That is why urgency, optionality, and principles-based decision-making are essential. They are not slogans. They are disciplines that separate those who navigate uncertainty from those who are swept away by it. Urgency begins with recognizing that the time to prepare is before the crisis is obvious. Most people wait for confirmation. They need to see the storm clouds darken, the markets break, the headlines scream. By then, the options are already limited and expensive. The window to act is when the risks are building quietly in the background, when complacency is at its peak and insurance is cheap. Urgency does not mean panic or reckless moves. It means treating the present moment as valuable, not something to waste while hoping tomorrow will be easier. Optionality is the natural partner of urgency. It is the art of keeping doors open so that when the world surprises you, and it will, you have more than one path forward. Optionality is not about predicting every twist. It is about arranging your finances, your investments, and your life so that you can pivot without being forced into a corner. A portfolio with cash reserves, liquid assets, And diverse exposures is a portfolio that can respond. An individual with low debt and multiple skills is a person who can adapt when a single source of income disappears. Optionality gives you the freedom to act on opportunity as well as to defend against loss. Building optionality requires accepting trade-offs. It often means giving up a little short-term return for long-term flexibility. It means resisting the temptation to be fully invested in the hot idea of the moment or to stretch every dollar for maximum yield. The mindset is closer to engineering than speculation. You design for resilience. You assume that some of your expectations will be wrong and that reality will test your plan in ways you cannot foresee. You hold cash even when it seems to drag on performance because you value the ability to buy when others are forced to sell. You diversify across assets, geographies, and time horizons, not because you know which will win, but because you know you do not. Principles-based decision-making ties it all together. Principles are not rules for a specific situation. They are tested guidelines that help you make choices when conditions change. They are the product of experience and reflection, often earned through mistakes. Without clear principles, urgency can become impulsiveness, and optionality can turn into aimless wandering. Principles give you a framework for weighing risks, for deciding when to act and when to wait, for distinguishing between a temporary fluctuation and a structural shift. They allow you to respond consistently even when emotions run high. To develop principles, you need brutal honesty about what has worked and failed in your own history. You look back at decisions, not just outcomes, and ask what you were really betting on. You examine how you handled stress and uncertainty. You learn from the patterns of success and failure, your own and those of others. Over time, these reflections become a set of guiding ideas. How much leverage you are willing to take, what level of drawdown you can tolerate, how you define a margin of safety. These principles are living documents, updated as you gain new evidence, but they do not sway with every headline. When urgency, optionality, and principles work together, they create a powerful stance. You move early, not late. You maintain the flexibility to shift when reality diverges from your plan, and you rely on a framework that keeps you steady under pressure. This is the opposite of trying to be a prophet. It is an admission that you will be wrong about specifics, but you can still be right about how to survive and thrive. The world ahead will not be a straight line. Economies will cycle, politics will surprise, technology will disrupt, and markets will humble anyone who believes they have mastered them. You cannot eliminate uncertainty, but you can decide how to meet it. Act with urgency before the need is obvious. Build optionality so you can adapt when the unexpected arrives. Anchor yourself in principles so your choices remain sound when emotions surge. Those who embrace these disciplines are not dependent on luck. They are prepared, and preparation is the closest thing we have to control in a world that never stops changing. Friends, the world is shifting beneath our feet. The rules we once counted on are bending or breaking. If gold reaches 34 zalalozen or silver 2,000 or thousands, I do not intend for you to be a bystander. I intend for you to have seen it coming, to have moved ahead of it, survive and thrive. So let me leave you with this. Don't wait until the crisis is obvious. Wait until it's priced in, and then act. In a world of uncertainty, I bet on real assets, on humility, and on preparation. Thank you, and may your decisions be grounded in prudence, courage, and clarity.